You are looking at a business moving nearly $500 billion a quarter,
Right.
generating almost $1 billion in free cash flow, and they're aggressively buying back their own shares by the millions.
Yeah, which is massive.
It is. I mean, by
Yeah.
traditional financial metrics, you should be looking at a total Wall Street darling here. So why is PayPal's stock down 25% over the past year, while the broader market is just, hitting all-time highs?
That is the big question.
Exactly. So today we are unpacking the financial paradox of ticker symbol PYPL. And just a quick reminder before we jump in, this deep dive is for entertainment purposes only.
Definitely. Always seek professional advice before making any investment decisions.
Right, please do. So for today's mission, we've pulled a diverse stack of sources to try and solve this valuation puzzle for you. We are parsing their official SEC 8K filings for Q1 2026,
Yep.
analyzing the latest price targets from Benzinga, gauging the retail investor reality via StockTwits, and pulling in some broader macroeconomic and crypto context from BNN, Bloomberg, and Femex. Okay, let's unpack this.
Yeah, the tension here is it's fascinating because if you look at the official Q1 SEC filing, it paints a picture of a company with an incredibly robust engine.
Right.
I mean, net revenues reached $8.35 billion.
Wow.
Yeah, which is a 7% year-over-year increase. And that actually exceeded Wall Street estimates.
Yeah.
And the volume of capital moving through their infrastructure is staggering.
It's $500 billion, basically.
Right. Their total payment volume TPV surged 11% to $463.96 billion.
Yeah.
And that's driven by 6.5 billion individual payment transactions.
Okay, so BNN Bloomberg actually pointed out that this top-line velocity is being heavily supported by resilient consumer spending.
Yeah.
Particularly from wealthier households who are basically just, shrugging off inflation and global tensions.
We're still spending.
They are, but, top-line revenue only tells you how much money touched the platform.
Right.
It doesn't tell you how much profit actually stuck to the company's ribs. Which brings us to the glaring red flag buried in these filings.
The user growth.
Yes. Their active accounts are completely flat at 439 million. I mean, sequentially, they actually lost 200,000 accounts. They are no longer acquiring new users.
And see, that stall in user acquisition fundamentally changes the valuation math for a tech platform.
How so?
Well, if the user base is flat, but your total payment volume is up 11% like we just saw,
Right.
then the growth has to come from squeezing higher transaction volumes out of the existing user base.
Okay. That makes sense.
Yeah, and the mechanics behind this usually involve a shift in the business mix, as consumers lean more heavily on unbranded checkout solutions.
Unbranded meaning like the customer doesn't even know it's PayPal.
Exactly. It's where PayPal processes the payment behind the scenes for the merchant without showing that classic, branded PayPal button.
Got it.
So as that happens, the overall volume spikes. But, and this is the key, that unbranded processing comes with significantly lower margins.
Which explains the concerning drop in profitability metrics I saw in the 8K. Because it shows GAAP operating income dropped 3% down to $1.49 billion, and net income fell 14%.
Yeah.
But the metric that really illustrates that structural shift you're talking about is the operating margin. It compressed by 182 basis points down to 17.8%.
That is a massive hit.
It is. A drop of nearly 2 full percentage points on $500 billion of volume is a severe bleed. It means every incremental dollar flowing through their network is becoming, materially less profitable to handle.
But the paradox deepens when you look at how much cash the business is still throwing off, despite that margin compression.
Right, it's still a cash machine.
Exactly. We're talking about $903 million in free cash flow generated in just 3 months.
Unbelievable.
And management is deploying that capital aggressively.
Yeah.
They returned $1.5 billion to stockholders through the repurchase of 34 million shares.
Yeah.
And they declared a cash dividend.
So it reads like management is trying to establish a hard floor for the stock, right? Like signaling confidence to a market that has basically stopped believing in their long-term growth narrative.
That's exactly what it looks like.
But if your operating margins are compressing by 182 basis points, you really only have 2 strategic choices.
Right.
You can either raise prices, which is, let's be nearly impossible in today's hyper-competitive checkout environment.
Too much competition for that.
Exactly. Or you have to fundamentally gut and restructure your internal operations, which leads directly into the new playbook being deployed by their new CEO, Enrique Lores.
Yeah, and Lores is orchestrating a profound corporate overhaul here.
A huge pivot.
The headline initiative from the filings is This commitment to achieve at least $1.5 billion in gross run rate savings over the next 2 to 3 years.
Okay, so wait. Are they cutting costs just to survive, or is this a genuine pivot to fight off their biggest rivals?
It's definitely the latter. It's about agility. The primary mechanism he's citing to achieve these savings is the accelerated adoption of artificial intelligence and automation.
Okay.
And this isn't just about, deploying a better customer service chatbot. It requires stripping the organization down to its foundational layers.
I really want to explore that. How does a legacy tech company actually extract $1.5 billion purely through AI efficiencies without, breaking their core product?
Right. It's risky.
Because historically, launching a new checkout feature required a labyrinth of middle management. You had teams handling compliance, risk underwriting, quality assurance, all sitting alongside the actual engineers.
Yeah, it was a very bloated process.
So it sounds like Loris is using AI to just collapse those intermediary layers.
That is the exact core thesis behind the restructuring. PayPal is completely flattening its organizational chart.
Wow.
They're reorganizing the entire company into 3 streamlined units. You've got checkout solutions in PayPal, consumer financial services in Venmo, and payment services in crypto.
Okay, so 3 core pillars.
Right. And by integrating AI coding assistance and automated compliance checks, both the technical and non-technical teams can execute faster with significantly less overhead. Loris is explicitly stating that the goal is agility.
And the most critical detail from the filings, I think, is that they aren't just dropping that $1.5 billion in savings to the bottom line to appease Wall Street analysts.
No, they can't afford to.
Right. They plan to reinvest a significant portion directly back into product speed and interoperability.
Because they have to. The structural landscape of digital payments has shifted entirely.
Exactly. Think about Apple and Google integrating digital wallets directly into the hardware of your smartphone.
It's a huge advantage.
It's like the grocery store owning the parking lot, the front door, and the cash register all at once. PayPal has to convince the consumer to actively bypass the built-in system and open a separate app once they are already inside that hardware ecosystem.
And overcoming that hardware-level friction is incredibly difficult. Apple Pay allows a user to double-click a physical side button and authenticate with facial recognition in a fraction of a second.
Yeah, it's seamless.
Right, so to compete with that baseline level of convenience, PayPal's checkout experience has to be flawless.
So that reinvestment is aimed at defending the legacy lead they built up during the pandemic.
Exactly. Ensuring their checkout button remains relevant when the physical and digital shopping experiences just blend together.
So as an observer, you listening right now, you have to weigh this internal transformation against the stark reality of the stock market. Because right now, institutional investors are punishing the stock.
Heavily.
We are looking at a price hovering between $50.39 and $50.90. The stock is down 14% this year alone and down 25% over the trailing 12 months.
Rough.
The opportunity cost of holding PayPal has been brutal, especially when you consider the S&P 500 is up 27% and the tech-heavy QQQ is up 38% in that exact same 12-month window.
Yeah, and that severe underperformance has completely fractured Wall Street's consensus. The Benzinga data tracking 40 different analysts highlights this uncertainty perfectly.
What's the spread look like?
Well, the average consensus price target sits at $67.21, implying the stock is undervalued today. But the spread between the bullish and bearish institutions is incredibly wide. Citizens Capital Markets has the highest target at $125.
Wow, okay. A $125 target suggests they fully buy into the turnaround narrative.
Completely.
Like they are modeling a scenario where the $1.5 billion in AI savings materializes, the share buybacks artificially elevate the earnings per share, and the company successfully defends its checkout market share against big tech.
Right. It's a classic deep value play assumption.
But on the other end of the spectrum, because there's always another end, Morgan Stanley has a target of just $34.
Right. And a $34 price target prices in structural obsolescence.
Ouch.
Yeah. It assumes that 182 basis point margin compression we talked about is just the beginning of a terminal decline. The bearish view is that unbranded low-margin processing will just continue to cannibalize the highly profitable branded checkout business.
And that Apple and Google will inevitably capture the mobile generation.
Exactly. And recent institutional actions lean toward this skepticism. You've got Truist maintaining a sell rating with a $45 target, and Mizuho downgrading their outlook from $60 down to $50.
So the institutional anxiety is palpable, but, and this is wild, The narrative completely flips when you analyze the retail investor data from StockTwits.
Oh, totally. It's night and day.
Everyday traders are looking at the exact same SEC filings. The flat user growth, the margin compression, the AI pivot, and they are drawing a highly optimistic conclusion. The sentiment data shows retail traders trending heavily bullish, accompanied by very high message volumes.
What's fascinating here is that the divergence really comes down to the investment time horizon.
How do you mean?
Well, institutional analysts are projecting out 5 years, right? They're worrying about a slow, irreversible bleed in market share. Retail investors are looking at the immediate term.
Oh, okay.
They see a company generating almost $1 billion in free cash flow in a single quarter, trading at a historical price-to-earnings multiple that just looks incredibly cheap compared to the rest of the tech sector.
Right. I mean, you see quotes from retail users explicitly stating that Q1 was way better than last Q. They're arguing the financials easily justify the stock trading back in the 70s.
Yeah, establishing a floor.
Exactly. For them, that $1.5 billion share repurchase program acts as like a corporate put option. They view management stepping in to buy 34 million shares as a definitive signal that a hard floor has been established under the stock price.
But to understand which side is likely correct, the deeply skeptical institutions or the optimistic retail traders, we have to look beyond PayPal's immediate checkout competitors.
You mean like Apple, Google, MasterCard, Amex?
Right, because they're all executing well, but we have to analyze the broader tectonic shift happening in the financial plumbing itself. Specifically, the elevation of payment services and crypto to its own core division within PayPal.
Yes. This is where the macro data from VNN, Bloomberg, and Femex becomes so critical. Because, I mean, Bitcoin surging past $80,000 captures all the headlines.
Of course.
But the underlying threat to PayPal is the actual architecture of tokenization. We are seeing crypto-native companies making really aggressive acquisitions to build completely new financial pipelines. The sources highlight Bullish acquiring Equiniti for $4.2 billion.
Right, and Equiniti is a traditional transfer agent.
Exactly. By bringing them in-house, Bullish is attempting to own the entire pipeline of tokenization, taking traditional equities or real estate, issuing them on a blockchain, and handling the settlement natively.
If we connect this to the bigger picture, the friction of traditional finance, the clearinghouses, the settlement delays, the intermediary fees, that is exactly what PayPal built its business on navigating.
It's their bread and butter.
Right. But if assets begin to settle instantly on-chain via tokenization, those traditional payment rails risk being bypassed entirely.
Wow.
So by elevating crypto to a core business unit, PayPal is signaling they recognize this existential threat. They are no longer just fighting a war of convenience at the checkout counter.
They're positioning themselves directly against crypto-native giants like Coinbase and Kraken to control the underlying movement of a digital value itself. But the question is whether a company carrying the technical debt of a legacy Web 2.0 infrastructure can pivot fast enough to compete with the native Web 3.0 companies built specifically for a blockchain integration.
It's a massive challenge.
It is. But the sources reveal a fascinating parallel that suggests even the crypto-native companies are feeling the exact same operational pressures. Because at the same time Enrique Lores is leveraging AI to flatten PayPal, Brian Armstrong at Coinbase is currently cutting 14% of his workforce.
Yes, and Armstrong explicitly stated that the headcount reduction at Coinbase is designed to flatten management and increase operational leanness in response to the rapid rise of AI.
It's wild.
It is a striking confirmation of an industry-wide reset. The middle management layer that really defined the last decade of tech expansion is it's being eradicated by the AI efficiency curve.
So both PayPal and Coinbase are looking at the exact same technological tipping point. You either integrate AI to strip away bureaucratic drag and speed up your deployment cycles, or you just get outmaneuvered by leaner competitors.
That's exactly the choice they face.
So, synthesizing all of these moving parts for you listening. You have PayPal, an absolute cash-generating machine moving $460 billion a quarter, but they are fighting a multi-front war.
Yeah, a really tough one.
They are battling flat user growth, severe margin compression, and a deeply skeptical institutional market. And to survive, they are tearing their corporate structure down to the studs, relying on an aggressive $1.5 billion AI-driven cost reduction plan to fund the defense of their core checkout business.
Right, while simultaneously standing up a new crypto division to secure a foothold in the next generation of financial infrastructure.
Exactly.
And, as a final thought to consider as this turnaround unfolds, look closely at the role Venmo plays in this ecosystem.
Oh, Venmo is so interesting here.
Right. The filings explicitly note that PayPal is exploring the expansion of Venmo's consumer financial services. Now, overlay that expansion with their new dedicated crypto unit and the broader industry push towards tokenized assets.
Okay.
Could Venmo be positioned to become the ultimate financial super app in the United States?
Oh, wow.
Think about it. An interface that seamlessly bridges your traditional bank account, your online checkout experience, peer-to-peer payments, and your on-chain digital assets, all in one single place.
I mean, if PayPal can actually integrate all of those disparate financial pipes into one frictionless application and execute that vision faster than the hardware giants or the crypto exchanges, that could provide the exact catalyst needed to unlock the structural growth Wall Street is demanding.
It really could.
The central question for you as an observer is how you weigh a historically cheap valuation against heavy structural competition. Keep a close eye on how management executes that $1.5 billion AI savings plan over the upcoming quarters.
Yeah, that's the metric to watch.
That operational execution will tell us if the underlying engine is truly adapting to the new financial landscape or simply running out of road. Thanks for joining us for this deep dive, and we'll catch you on the next one.